Citizens of the world, welcome back to the Keep Yours podcast, where we try and keep a few dollars in your wallet so you can spend them on the things that you want to, or wait for your government to steal them from you one way or the other, via taxation or inflation. At least you get the upfront one with taxes, and they tell you what they're taking, and then they rob it out of your back pocket with inflation, and pretend like they're helping you out by sending you a stimmy check. So today's educational topic is our bullshit recovery, and that is a bit of an homage to Chris Irons. And if you don't know who Chris Irons is, he runs the podcast, what is the name of it? Quaff the Raven. And highly entertaining, but he has a series going on called Our Bullshit Economy, and I couldn't agree more, so this is our bullshit recovery. And I'm going to show you a bunch of the crap that they're feeding us and why they're wrong and lying to you constantly, which should be of no surprise, but also goes into the don't believe the hype, and you might want to protect yourself a little bit. So let's start with what they're telling us. And what they're telling us is the economy is showing sustained progress. And this one is from last month. It's a couple weeks old. But basically the Federal Reserve is saying the same crap all the time. Things are getting better. All of the inflation is transitory. It's only going to be here for a little while as things get back to normal. We're not going to tell you why there's massive inflation. We're also not going to explain to you why inflation's needed, because if we did that, we'd have to explain to you why debt is good, and we don't have an explanation. But let's start with the bullshit math. And I realize that this chart is not fantastic. Let me see if I have that one that I could just pull up. I just cut this from GDP, but I could also just Google GDP by year, and we can see that. All right, so if we look at GDP, and here we go. Here's some the numbers for us, and they say that we're growing right now at a pace of what did that article say? What did Jay Powell say? He said that the economy's doing great, and we are growing right now at 3% or some crap like that. Whatever they say the growth rate is. But what I'm going to tell you is all you have to do is some very, very simple math and go, it's nonsense. All right, so this shows that where we were in GDP, and that is 21 trillion in 1919. Okay. So right now we are on pace for 5.5 in Q1, multiply that times 4 for about $22 trillion of GDP. Okay? So if we say we're at 22 trillion, but then we go, well, wait a minute. We've got 3 trillion. Here's that actual article that I pulled this from, right? So Q1, it said we grew 1.6%. Right, so this is going to become 22 trillion, but we've got 3 trillion in deficit spending. So if we take the 3 trillion off of 22, we're left with 19. 19 trillion is 2017 size economy, not a growing economy off of, growth from last year, but that was negative, right? Growth from what? But it's also not sustainable. And what I'm saying is it's not real. Let's tell you what the real economy is. What is a sustainable economy? Right? So when the government's borrowing money, and I've said this for many years, right? 2019 numbers, 21 trillion, that's not a real number either, because the U.S. ran a deficit of $1 trillion. So I equate that to, it's the same thing as your personal life. If you take all of your credit cards and you go out there and you max all of them out, and let's say you have $100,000 worth of credit card ability, and you go buy $100,000 worth of stuff and you put all that in your garage, are you $100,000 richer because you bought all the stuff? No, because on the other side of your personal balance sheet is the $100,000 in debt that you have to pay back. So you have the things and you owe the money, but you're not $100,000 richer. And this is what the government's saying. The economy is growing even though we're spending money that we can't afford to spend. And so it'll keep growing because once we've propped it up on this spending, all this spending will continue. And that's what I'm here to tell you today is bullshit. 100% bullshit. It's just not real. It doesn't work that way. At some point, you have to pay down your debts. And when you do, how do you pay back your debts personally? You can make more money and pay them down, or you can stop spending as much and pay them down. Right? Well, the government's believing it's going to make more money somehow because it's increasing all of this spending, right? Which it will get some of it back, but most of it will not. And the return on that money is less and less. And I'm going to show you the people who talk all about that all day and know what they're talking about much more than me. All right. So our economy bullshit number 2 is unemployment, right? So if our economy's doing so great, then why are we giving everybody all these pandemic employment benefits? Why wouldn't we have just shut them off? And why wouldn't the number of people receiving them be dropping precipitously? Now, the number is coming down because 22 states, I believe, have said we're no longer giving out free extra government money because that's preventing people from going and looking for a job, which of course it is, despite the fact that the government wants to tell you that they're not gonna. But I'm bringing this up from a different perspective. What's going to happen in September when all of these benefits go away? What also happens this year when all of a sudden people have to pay rent and have to pay their mortgages and have to pay their student loans? Now, is our economy growing and all that money being spent, or do all those people stop spending on all the things they're currently spending on and now have to pay those bills that haven't been paid? Good question. But I can tell you this, all of these people collecting money, once they stop collecting money, are going to stop spending money. And that's why this recovery is mostly bullshit. Because it's not sustainable, because you can't just keep giving all these people free money despite the fact that the government really wants to, and these MMT idiots think that you can for forever. You can't. The other reason this is bullshit is because all they really did with all this money printing was make rich people even richer. U.S. household gained $13.5 trillion in wealth in 2020. Now, first off, how are they measuring that? I don't know. Maybe it's the value of everything, because everything's all propped up on these crazy valuations. If the stock market's up 18% and the real estate market's up 12%, then everyone's that much richer. But you're not really richer until you cash that out. However, most of this wealth went to the top half of 1%. Most of this wealth did not go to people who actually needed it. They gave part of the reason we've got such crazy, I'm going to say, not just inflation, because the inflation's been caused by the government giving everybody money, but the government did two really stupid things at the same time. One, they gave everybody unemployed money, enough such that they gave them an incentive not to work. And then two, the really dumb thing they did was they gave money to people who didn't need it. And I did a podcast on a stimmy check and why you don't want a stimmy check. You can go listen to that, and it'll tell you why you don't want to get a stimmy check from your government that's already broke, because they don't have the money to give you and they're going to have to tax you for it later, which they will in one way or another, whether it's through inflation, which is one tax, or whether it's actual increases in tax rates, which at least is honest up front about it, right? So instead we believe that we can just give everybody stimmies. And now I realize that they're trying to roll out kid stimmies. Well, one of the reasons they're trying to roll out kid stimmies right now is because they realize all of these people are about to stop getting unemployment benefits. Well, if they stop getting unemployment benefits, then they don't have money. And they have to pay rent. And they have to pay a mortgage. And they have to pay a car payment. So all the payments that weren't having to be made now have to be made. What happens then? Are we growing at 3%? Are we growing at 5%? No, we're not growing at all. Spending debt is not growth. And in fact, as I will show you later, spending debt on the long term, once it reaches a certain percentage, and we're well past that, is detrimental to growth. So actually what they're doing is they're slowing down future growth by putting more debt burden on all of us. That's the reality, right? All right. So here's how you know when the market and this rally is complete and utter bullshit. Here's what we've got. Junk bonds, yields below inflation. So let me explain how junk bonds work a little bit. Junk bonds are like people with a poor credit score, poor credit rating. It's basically companies with a poor credit rating are rated junk bonds. Okay? So if you go to loan money to people, and I did a podcast on this back in the day about why you pay a certain interest rate. Part of that interest rate is for inflation, because when I give you my money, if I'm going to loan you $1,000 and you're going to give it back to me in a year, if I could buy a television with that $1,000 this year, I want to be able to buy that same television in the future. It's called, I want to maintain my pricing power. So if inflation's 5%, I'm going to charge you at least 5% interest. Then I'm going to charge you a risk premium. That risk premium is based off of your ability to repay that loan and your history of repaying loans. So companies that are known as junk bonds, well, they don't have a great history of repaying their loans, and there's a risk that the company might actually go into bankruptcy and default on that, in which case you're usually left with some useless stock and probably 20 cents on the dollar. So there's a high risk premium associated with these bonds. But what the market's saying right now is not only are you not even getting back the premium for inflation, you're getting zero premium for your risk. So we are in a no risk premium market. We had one of these no risk premium markets before. We did it in the housing market, where we gave everybody who wanted a loan and treated everybody as though they had no risk. Remember that one? How did that one end? Yes, it ended in such things that they call it a great financial crisis and a great recession. Yeah, okay. So here we are. They're doing this again. This is on the company side. Now, then there's the question of what is all this debt being used for? Now, in a good forming economy and where growth is real, companies would be investing this into property, plant, and equipment. Do we think that's happening with all of the debt now? Or are companies doing additional stock buybacks and using all of this debt to buy back more stock? So let's do a quick little scan here of amount of corporate debt buybacks. Actually, let's just go stock buybacks. And my guess is that they are at also some probably long-term high, right? Those are the announcements I want. Now, what companies should be doing right now is selling shares and paying down debt. But instead, what are they doing? They're borrowing money and buying back their own stock, right? Why do they want to buy back their own stock? Because if the stock price goes up, they get a bigger bonus. And what executive doesn't want a bigger bonus? Oh, that's right. All of them want a bigger bonus. So that's why they do it. But it's not a good thing to do in general, right? So let's see if I can find somebody that is talking about buybacks and get past some ads. Well, it looks like I'm going to have to dig into this to... Looks like I might have to dig into this a little bit more. But here we go. So, Harvard Business Review. That's a decent publication. Might be able to believe them. Companies increasing stock buybacks. So they only go to 2018 here. But I would guess that 2019 and 2020 were also massive. This was written in 2020. So people are using all of this debt to buy back stock. So buying back stock is not going to increase your long-term earnings. This is my whole point of this bullshit recovery. So we've got this $11 trillion in corporate debt, but it's not being used to fund useful things that increase profits and increase returns down the road. Instead, it's being used for short-term things like stock buybacks, which don't actually improve the company's position at all, except for it makes the stock price go up. But that's, again, what I'm saying is it's one of these things that we need to address in the world right now, which is incentives and incentives for people running companies. And they should not have the short-term incentive to try and get the stock price to the highest price. They should have the long-term incentive of trying to increase the company's profits, not increase the company's share price. Those are two different things. However, one is typically a multiple of the other. And right now that multiple is insane. We'll talk about that in a minute. But this debt problem that we have is not just in corporate debt, okay? This debt problem that we have, and we're going to talk about this in a bit of detail here, is federal debt, right? So here's the Fed chart on federal debt, right? To a number that 28 trillion plus, okay? And let's look at the amount of debt by year, right? So again, this goes to me saying, and this is in millions, right? So this is minus 280 million, a $2.8 trillion, and this is only updated through 2020. That's as far as they'll let this chart go. So we'll see that 2021 was even more than that, and 2022 will probably be more than that. So we're adding $3 trillion of debt. So again, we're saying the economy is growing, and we're going to have a $22 trillion economy. But if we take out that $3 trillion of debt spending, we don't have a $22 trillion economy. We have a $19 trillion economy, which is lower than 1990 or lower than 2018, I think. Now, again, each of these last years, massive amounts of debt, right? And especially, look what happens when the Republicans take over. So we had about 480 billion of debt, right? And then all of a sudden the Republicans just keep spending and spending and spending and spending. So the party that's supposed to be the financially conservative party turns out they're not really the conservative party. You see the same thing in here. When Clinton leaves office and Georgie Boy comes to town, what happens? The debts just start piling up more and more. And then, of course, I'll give Obama the first year. I'll give him till 2009. I'll say that that's the Republicans' hangover right there. And then they were trying to reduce it a little bit going forward. Couldn't, right? Couldn't get it all the way back down because this catastrophe let me remind everybody how that catastrophe happened. Because they gave everybody easy credit. Because they, just like we're treating these bond markets right now, these junk bonds, where there's all the risk with no premium. Guess when we did that the last time? Housing crisis, anyone? Homes only go up in price. So we'll just give everybody all the loans that they want. We don't care who they are. We don't care if they're junk bonds. We have another rule for that, another name for that when it comes to people. Subprime mortgages. Sound familiar? Subprime mortgage is the same thing as a junk bond, right? The junk bond attached to a company, the subprime mortgage attached to a person and a home, right? But that's exactly the same thing that we had back then. Super low rates, giving money to anybody who asked for it. What could go wrong? And how does that affect the future? So, to talk about how that affects the future, we're going to look at, one, what the government's doing right now with inflation. Okay, so here's the inflation. 5.4%, and this is straight up CPI inflation. That's not even the real deal, right? We know home prices went up 12%, and they're not wanting to address that. They're going to, right? But what I want to talk about, and I think is more important for you to learn about, is what's the impact of all this debt on long-term GDP growth, right? Because we say, okay, the theory that these idiots have is that the government's going to spend $3 trillion this year and $3 trillion next year, and then because of that government spending, all of a sudden real GDP from real companies is going to go up. Well, some of that would have been true in the past when debt levels weren't as high, one, and two, when that debt was actually used to build something, to do something real, to build infrastructure that would actually help everybody to bring products to market and make life cheaper and easier for everybody. But that's not what most of this money is going to. As we know, most of this money is just going into people's pockets. You can't increase everybody's personal wealth, by an astronomical amount, which is what they've done, right? And it's hilarious. Here's the perfect article on that. The economy is unlike anything you've ever seen. Everybody's got money in the bank. The Dow's up. Home prices are up. There's trillions in extra savings from people's bank accounts, right? Home income went up for everybody, even though nobody got an increase in wages. They just got free money from the government, right? And then they had a lot less spending because they weren't doing anything because they were locked in their house, right? So all of these things, and they're like, hey, this is all great, right? It's not like you've seen it before, but all the households, they're richer than ever. But they're not, because inflation's going to kill most of that money anyway. And then when all of a sudden all this debt has to come out of the system, all of these presumed gains in value that we have for all of our assets are going to crash off with everything else. It's the inevitable, right? And this is the more debt is bad for the future. This is the summary from Dr. Lacey Hunt and his investment firm that he works for, Hoisington. And this is their quarterly review from second quarter 2021, right? And you can go through this, and they explain, as do their previous pieces, what happens when you spend debt, right? And what happens with money velocity. And money velocity falls as the amount of debt increases over a certain percentage. And basically what they say is up to about 60% of GDP, you're helping grow your economy. Beyond that, it's a detriment, and every additional dollar results in less growth, right? So what he's saying now is, R2, which is what they're talking about here, which is amount of revenue you're going to get back from spending a dollar, is 0.98. So an additional dollar of debt doesn't give you back a dollar. It gives you back less than a dollar, right? And so basically what they're saying is more debt equals lower growth, which 100% it does, because you have that debt hangover. Same thing in your household. If your household income goes up 5%, but your interest rates go up faster than that because of all the stuff you've bought before, you're not richer. You just have more debt payments that are due. If you go out and buy $100,000 worth of goods and run up all your credit cards to the max, you're not richer. And in fact, you're poor, because the next year you have to pay all that interest expense. The same thing. All the debtors have to pay interest expense. So when debts are at an all-time high, guess what? Interest expense is an all-time high as well, which is why they've crashed interest rates down to zero. So they tell us economic growth is great. Well, if economic growth is great, how come you can't normalize interest rates? How come you can't stop Fed bond buying? That's not indicators of a great market. That's indicators of a shit market, which is why we have a bullshit recovery. This is exactly my point. So you have to look at all of the different things, not the headline that they're telling us, which is, oh, things are great, the inflation is transitory, everything's going back to be great. Well, here's their conclusion, and this is the part where everyone needs to pay attention. Today, the best evidence suggests that the following. 1. Monetary and fiscal actions are largely impotent in stimulating economic activity due to the massive debt overhang in the U.S. and most major foreign economic powers. 100% agree with that. How could you not? What, you don't agree with the debt numbers? You don't think that's real? I already showed it to you. This is federal debt according to the Federal Reserve. This is how much the government owes, 28 trillion plus. Okay, 28 trillion and growing, right? That's your federal deficit. So, because of that, that's going to slow down future economic earnings. Point number 2. While taking on more debt does produce a fleeting benefit for economic growth, such actions embroil the economies deeper in a debt trap. This is exactly why I want to do this podcast. That is exactly the sentiment of which I am saying. You cannot have $3 trillion of debt spending and tell me the economy is growing. That's not growth. That is a fleeting benefit, a fleeting number. And again, back to number 1, once you've got more and more debt overhang, you've got future lower growth. So effectively, it's like the more you print money to take care of the problem, the worse the problem gets, but their only solution for taking care of the problem is to print more money. So their only solution is to make the problem worse. Welcome to government. Number 3, central bank tools have the capability of restraining economic activities, as well as illustrated by tightening actions from 2016 to 2018. All right, so this is where I'm saying, okay, well, they should go increase interest rates if we have a real economy, right? But if they increase interest rates, what happens to the debt payment service on the 11 trillion of corporate debt, the 14 trillion of individual debt, and the 28 trillion of government debt? the debt service cost goes up, which means economic growth goes down even further. So this is why the Federal Reserve's trapped. And when they're talking about we might raise rates to deal with inflation, it's complete BS, because as they discuss in here, when they tried to increase rates a little bit and tried to do bond tapering a little bit in 2016 and 2018, the market went bananas and they had to call it off. And that's exactly what's going to happen anytime they try and do it again. All right, number 4, fiscal restraint, i.e. the government spending, to stop spending money they don't have. Right? That's what fiscal restraint means. Fiscal restraint means you stop spending money you don't have and start paying down some of your debt. So they said fiscal restraint would temporarily diminish economic growth, but if it could be sustained, the debt overhang could be worked off and in time the economy would recover. However, in a democracy, it is highly unlikely that a program of fiscal austerity would even be proposed and, if taken, surely not sustained. At the first sight of transitory weakness, the body politic would demand an easing of the restraint. These 4 conclusions are consistent with the McKinsey Global Institute 2010 study of highly indebted advanced economies from 1900 to 2008. 100% agree. This is the new paradigm we're living in. When the Fed says that inflation is transitory, what they're saying is the government's not going to continue to print money that they don't have. However, these guys, and I agree with this as well, right? Democracy, they won't even propose it. Are you kidding? Is there anyone in Congress proposing right now that not only do we not run a deficit, but that we actually run a budget surplus and the government stops spending money altogether? So that GDP growth of whatever that bullshit number is would be negative? And we'd have an actual recession, because that's what is required. We have to get rid of all of the debt. You have to consolidate that down back to what's affordable based off of people's earnings and company earnings. But nobody wants to do that. Are you kidding me? You want to talk about the fastest way to get elected out of office? Allow a recession to happen. As though the government's in control of it to begin with. They're not, but people believe that they should be, because people are idiots. That's just the reality. People don't understand how this system works. It's the exact reason why I started a podcast, to try and help educate people on how this system works. More debt is not good for you. More debt is not good for your company, and more debt is not good for the economy once it's over a certain amount. Where are there good pieces of debt? Okay, well, if you have to take out some debt to buy a car, but the car allows you to get to work, and the work allows you to have a job, and the job allows you to earn more money than you would be able to do without the car, and you make more money than the car payment, then the debt is good for you, right? If a company invest that debt in property, plant, equipment, and people, such that they can produce more goods and services, hence that they can increase their revenue, and pay off that debt with the increase in revenue, then that debt is good. If a government spends some debt and that increases roads and bridges and transportation and communication, and that allows companies and businesses to thrive, and therefore earn more money and therefore pay more in taxes, then the government gets its money back. But when all you're doing is sending out stimmy checks, all you're doing is buying things on your credit card, that's not increasing your wealth. If companies are using debt to do stock buybacks, that's not increasing their future production. That's not increasing the amount of goods and services they have to sell to the public, increasing the amount of money they have for debt service, and therefore allowing them to prosper in the future. So we have to take out this non-prosperous debt. But that's a problem because it's politically unsavory. And I don't think anyone's going to do it. But meanwhile, they're going to send out all of their cronies who have spent their whole life in academia and believe that they can control the financial monetary policy in these nice tight windows when they can't, and it's full of crap. And this is what they send us out. Oh, the economy's recovering. Don't worry, everything's going to be great. No, it's not. No, it's not. It's bullshit, right? Our GDP is not growing right now. This is not real growth, right? Again, all you have to do is take off the federal surplus, right? Okay, so $3 trillion we don't have minus $2.2 trillion, and you're back down to, 2016 size economy? Doesn't seem like we're growing. Seems like we're going backwards. And then if you took off the debt from these prior years into each of these periods, right? Now, in some of these periods, it's not as much. right? But if you took out like in 2009, that's what it, so this is another indication of how the debt problem gets worse and worse. And you can see it in this graph, okay? So when you have problems, like here's the internet bubble crash, right? So the government has to step in and spend some money to pull us out of that recession. How much do they have to spend? About $500 million. Or no, wait. Sorry. That's in millions. So it's like 400 billion that they spent in here. Right? Now all of a sudden we get down the road, we've got massively more debt. Okay, so by 2007, we go from 2000 to 2007. Now let's look at federal debt. So from federal debt to, now we need to go back to 2007. Let's just go back to 2000. Okay, so we go back to 2007, and we see that total debt in the U.S. was about 8 trillion, right? And then we go, we're going from 2000, here to 2007. Okay, so if we look at the federal debt in 2000, it's 5 trillion. We look at the federal debt in 2007, and it's 8 trillion, right? So we had to spend a proportionate amount of money more in 2008 to get out of this debt, right? Increasing the debt because of all the money that they spent. But now, all of a sudden, so these caused more debt spending to get out of the debt, right? More debt spending to get out of the debt, more debt spending to get out of the debt. And you go, well, what happens next time there's another crash? How much more is that going to cost us? And this is kind of showing the inverse relationship of what's happening. So all of that, it's exactly what they were just describing in that paper, that more debt puts constraint on future growth, right? Which means that the next catastrophe costs more debt to get out of. And so as you can see, the catastrophes, 2000, bubble burst, right? Now, a lot of that was just in the stock market, but, pieces of it hit. So they do some government deficit spending, right? Oh, and also we go to war. Don't forget, 2001, we go into war. We got to go fight wars in foreign countries. Those cost money. We increase debts, right? Now, all of a sudden, 2008 gets here and the market crashes, and all of a sudden we have to spend a bunch of money, right? That one costs us 1.2 trillion to get out of, right? Now 2020 comes and it costs us 3 trillion to get out of. So what's the next one going to cost us to get out? 5 trillion, 9 trillion? And if you look at the Fed's balance sheet growth, right, in 2007 it starts growing. It's about 4 trillion. By 2014, they've never been able to taper it, and now they doubled it in 1 year. So again, this proves how suffocating your long-term debt is. And anyone who's had to live with debt on the long term knows this. If you graduated from college and you had a student loan payment and a car payment and a house payment, and you had to make all those debt payments all the way along, and you lost your job at some point along the way, you know how overwhelming all of that debt can be. And this is where the U.S. economy is. It's hard to thrive in that environment, right? So the U.S. economy needs private sector jobs to make up a lot of trillions of dollars that the government's spending. Well, that can't happen quickly. That's going to happen over time, right? And the more debt they throw on this, the bigger the hangover, right? This is like telling drunk people that the answer is more vodka, right? You know what helps too much vodka and being hungover? More vodka. Just trust me, you'll just be drunk again, and then you'll feel great. And then when eventually you wake up and you have to deal with that hangover, it's going to be a nightmare. So all around us, we can see that the economic recovery and all the things is bullshit. We've got inflation that's super high. We've got tons of people still collecting unemployment benefits that are about to run out. What happens when that money goes away? Right? Not good things happening, not growth in the economy. Bad things happen. Okay, then we say, well, those people will all go find a job. Do we believe there's going to be jobs for all of them? I don't. I look at the current unemployment data and go, that's really high considering all of these people aren't trying to work, and everybody's hiring, and there's still layoffs every week? And then you go, well, some of those layoffs are somewhat transitory too. The car manufacturers can't get chips, so they can't put the chips in the cars. That means the car lines are shut down and people are laid off. True. 100% true. But not all of those jobs will come back, as is always the case. If all of the demand has been pushed forward and everyone has a car, then they turn the car factory back on and they make all of these new cars. Well, now who's going to buy them? And that forces car prices down. Well, then everyone that just bought a car in the last year under these crazy high prices, now they're underwater. Because car prices will again drop. This idea that used car prices are going to keep rising is absolutely ludicrous. No, car prices are not supposed to rise. Right? That just shows you what the hell is going on. It shows you what nonsense it is. Right? And here is a great quote. Right? An imbalance between rich and poor is the oldest and most fatal ailments of all republics. Remember, the United States is a republic. Your U.S. government is creating a wealth gap that is massive. Right? It is the biggest it's probably ever been in America. You know, yeah, everyone got rich. Especially the rich. Right? This is the whole point. Especially the rich. That's a problem. Right? If we go into, I'm sure they're going to give us the top 1% in here. More than 70% of the increase in household wealth went to the top 20%. A third went to the top 1%. A third went to the top 1%. The people who didn't need any of the stimulus got trillions in stimulus. That's basically what I'm saying. And you don't think that those really rich people also are starting to get out of the market, also are not going to be caught by all of this crazy euphoria that's going on in the markets. You know, wealth among the bottom increased 20%, increased by 50 billion. Okay, so 20% of people, their wealth went up by 50 billion. 1%, the top 1%, went up by 4 trillion. That doesn't make any sense. Okay, except for that these charts just show it great. Everybody else got this much. The top 1%. Oh my goodness. Thank your government for all this wealth inequality. They are the only ones that could do that. There's no way, if we had real sound money, the government did not have the ability to print it constantly, that this could happen. But that's exactly what has happened, right? So you're telling me on the spending going forward, right, all of this money from the top 1% is going to be spent the same as that bottom 20%? And that, remember, the bottom 20% is right here. 550, no, did it say 50 billion? It was some sad number. 50 billion. 50 billion. The top 20 for the 20%. So what happened is in the middle, a whole lot of people who had their jobs spent a lot less money, plus got stimmy checks, right? And now they're putting all of that money into the stock market, and that's helping push up prices too, and especially those stimmy checks, right? So if you want to talk about a bullshit recovery and the reason that asset prices are inflated so much, just think of it this way: if you're walking into a casino with your own money that you earned, you're going to have limits on the bets that you place, and you're going to be drawn to higher probability bets because you're going to lose the money that you earned. But if you walk into the casino and they hand you $5,000 in chips when you walk in the door, you're not going to be so concerned with the percentage because you're playing with house money. You don't care. Take the biggest bets because they pay off the biggest. So, you know, this is the AMC crowd. It's, you know, diamond hands. Let's take this thing to the moon. You know, let's keep doing that. Well, that's what's going to happen when you hand people money walking in a casino. They're going to make crazy bets. And that's exactly what's going on in the stock market. People are making crazy bets. And because of this, everyone thinks that everything's only going up, right? So when we look at the jobs, right, Jobs paying more than 60 grand a year grew 2%. Right? And jobs paying less than 20,000 falling off. Right? So we got a whole lot less people working. Right? The Americans who gained the most were the ones who had the wealth to begin with. That is not a good positive for long-term economic growth. Right? It's just the reality of it. This is what they did. Right? They're killing everybody. Now, what I would be concerned with if I'm on all of these levels is what's the value of this really, right? So if we go back to that Buffett index, which I don't even know if we've talked about yet, Buffett indicator of stock market being overvalued. It is, of course, the highest it's ever been, right? And then we go, okay, well, if this is the money you think you got richer in equities, and this is your pension money, and that's also in the stock market, and this is your real estate that's been pumped up by this latest run in real estate, how many of those things have the potential to fall? And how do we get out of these near zero interest rates without real estate prices coming down? And this is why I'm saying it's a bullshit recovery, right? This isn't just, I feel like something's wrong here. It's math. The data doesn't match up. And this last piece here is very, very true as well. A handful of tech giants are benefiting, carried the entire market higher. That's also continues to be the path. As the individual investors rush in, which is also happening, and junk bonds are paying no premium with all of this risk, right? The market's trading at all-time highs and way off of what it should be in terms of what fair valuation is. The historic trend line, Buffett indicator, oh, look, we're in mass euphoria. What's going to happen when all that falls apart? Right? And what I think we're going to end up with is more like 1940s inflation. Because exactly what Lacey Hunt said in their report, exactly what we brought up earlier, right? Highly unlikely that they'll be able to sustain not printing money, right? So the inflation that we've been experiencing is from them printing money. And that also, because of the inflation, if we all buy the same amount of stuff, but inflation goes up 10%, then it looks like GDP rose 10%, but it didn't. The government just printed 10% more money. So again, more bullshit data. But here's what happened in the 1940s, right? And you can think of this the same way. Government printing, no government printing. Government printing, no government printing. And I think that's very similar to what we're going to have going forward now, because the stock market's way overvalued. So we're going to have deflation in real assets in terms of, well, not in real assets, but in, we will have deflation across the board in assets, but especially in companies and stock price assets. So I think what we're going to see is continued increase in pressure on inflation for goods and services that everybody uses, so consumer prices, because the government's going to keep printing money and putting it in people's pockets. And then we will see deflation in asset prices because, well, we'll just return back here to the norm. Prices are going to have to drop a lot just to get to the norm. And once prices start dropping, do we believe that it's going to drop to the regular? No, it'll get down here like the last financial crisis did. This one's probably worse, longer, going to be with us for a while, right? And then they're going to try and print their way out of it. And so we'll go back and forth between inflation. They're still printing money, just not as much. So we will have deflation in asset prices, but inflation in consumer goods. And then jumps in inflation in consumer goods again as the government prints money. And then eventually, once they can get the debt resolved down to a reasonable degree because they've reduced the cost of all of that debt. Remember that inflation helps debtors. That's who it helps, right? And so this is why my long-term strategy is you need a hedge with some debt. Hopefully your residences, your principal residence is usually people's number one way to take out debt and have some leverage. And that debt then gets inflated away because hopefully your wages go up. Your wages won't rise 11%, but maybe they'll go up 5. They won't go up 7 here, but maybe they'll go up 3. They won't go up 3 here, maybe they'll go up 1. But if your long-term mortgage is locked in at the same rate, and your wages are rising, then you have more dollars to repay that loan with. And who's the loser? Whoever's holding your loan. Probably backed by the federal government, probably bought by the federal government. So once again, all of us citizens, we're about to be taking these losses on all of this debt that's due, right? Meanwhile, trying to get the federal government out of debt. And you see the problem that we're stuck in. We have this huge, huge leverage problem. And thanks to Dr. Lacey Hunt and those like him for pointing that out and showing the law of diminishing returns, showing that more debt is bad. And anyone who's been in debt knows that. If you can barely pay your bills, and the U.S. government can't pay its bills are being paid by the Federal Reserve borrowing money, right? This is the government paying its bills. It's $28 trillion behind in paying its bills, right? So when does the world decide that the U.S. repaying its bills is less likely and therefore wants a risk premium, i.e. a higher interest rate? Well, you can't pay higher interest rate. Think if they just moved interest rates back to 5%. 5% on $28 trillion is over $1 trillion. It's $1.4 trillion. That would be a third of the government budget would have to go to interest rates. But they can't do that. So they have to keep interest rates low while they keep inflation higher. The inflation higher is because they're printing the money, right? And then in doing so, GDP will rise, not in real terms, in terms of actual goods and services, in nominal terms because they printed all these dollars. But that will allow them to, if they get the same amount of tax revenue as a percentage of GDP, tax revenue will rise. But at some point they have to stop. They have to stop the continued growth in debt. Right? They can't keep running deficits of $3 trillion and pay this back, even with inflation-adjusted tax receipts. Right? Because again, the rest of the economy is going to be hurting too. So all those companies going out of business, that's not more tax revenue, that's less. Right? And we haven't had this flush out of all of these bad assets, which is a requirement for the economy to get going again. And I mean, they said it perfect in here, right? I mean, you know, if there was fiscal restraint, you know, would temporarily diminish economic growth. But if it could be sustained, the debt overhang could be worked off, and in time the economy would recover. But that's politically unsavvy. Unsavory. And the politicians aren't going to go for it. So what are they going to do? They're going to keep spending money, as they're already trying to do. Look at the next bill being presented right now. We want to spend another $3.5 trillion that we don't have. Right? Because what most people don't realize is that the actual money the government has to spend is not very much. Especially if you assume they're going to continue the defense spending. They probably have between $500 billion and $1 trillion that they actually could spend that's not already spoken for. The rest is already spoken for. It goes to pay for the programs that are currently in place. Medicaid and Medicare, you know, and Social Security. And guess what we've got? The boomers, who are going to acquire more and more and more money. So the government has less money to spend every year because of market demographics, right? Meanwhile, they want to spend even more. And then they want to tell us this is real growth. Well, that's bullshit. That's exactly what I'm here to say. This is bullshit. And because they're printing the money, the markets are going higher, right? In the second half of the year, S&P notched new records 33 times. It's doing the same thing in 2021, new records all the time, right? Prices in homes up 14%, right? It seems like a boom, but yeah, now guess what the downside of that is? Home ownership's out of reach for lower income people, right? And banks are tightening credit standards, so banks aren't going to lend anymore, right? This makes no sense that price of homes go up this much. Price of homes are supposed to go up on a nice even keel. If we look at before 1990, they went up with inflation because the goods required to build them went up with inflation. This is crazy. This looks like speculation. So we're in a recession and home prices are going up double digits? I don't know. Seems like we're getting ready for some stagflation here, or we're going to have inflation without real growth. But this is the whole message. This is the learning piece. This is a bullshit recovery. The economic growth they're telling us we have is not real. It's actually what's transitory. The inflation is as transitory as the government spending, right? Because if you want to go to the Austrian sense of inflation, and I've done a few podcasts on inflation, feel free to go back and listen to them. The Austrians would tell you that the inflation happened as soon as they printed the money. There's more money chasing the goods and services, therefore prices rise, period. Right? Now what actually happens is it takes a while for that money to get out there. It takes a while for it to be spent. And there's a lot of psychology built around that. When people believe inflation's coming and coming for the long term, then they're going to change behavior. At the moment they change behavior and everyone goes running for assets, that's an issue. But how about all these people, the bottom 20%, who are on unemployment benefits, whose wealth increased the least last year, but that's 20% of the population. What are they going to do this fall? What happens this fall when people with student loans have to make those student loan payments? When people haven't paid rent, have to pay rent. When people haven't paid their mortgages, have to pay their mortgages. And when the free checks run out for unemployment. Do we really believe that that growth is continuing into the fourth quarter? I think not. Okay? So what happens when what happens when all of a sudden company profits don't match up with company valuations? When does this market reach a peak? And then when does it fall off the cliff? Right? And as you see, these things usually don't go down in an orderly fashion, although this one's pretty much straight down. But you can see in here, this is the government says it's going to do something. We believe that's going to make things better. But the government can't just make everything better. And then once the reality sets in, and this is the amount of time that it took for all of that debt to come out. So if you think about the amount of debt that had to get flushed out, amount of bad debt, it took almost 2 years for that to happen. Well, now if you look at the volume of debt, how long is it going to take for this downward trend? And where's it going to end up? How far down here? I don't know, but I think it's going to be ugly, and I want that to be something that you're considering. So don't believe the hype right now, right? Do not believe what they're telling you, because the reality is we just got the best, in my mind, the absolute best indicator that we're at a top, and that is that retail investors are plowing into the stock market at a record pace. Right? This is people who have no idea what they're doing and haven't done it before, rallying the market to new highs. And that is almost always the contrarian indicator that the markets have reached a high. Because while the general ethos of investing is buy low and sell high, i.e. buy when there's blood in the streets and sell when there's euphoria, what most people do is the opposite. And so they're in buying right now in the euphoria, right? And not waiting for the blood in the streets moment because of fear of missing out on all these great gains. Well, just beware. That's my message, is beware. And protect yourself. Don't use leverage in these markets. And know that there is a huge possibility, and I would tell it a potential eventuality, that these markets go south and go south a lot, right? There is a high degree of probability that this correlation of fairly valued has to come back to reality, because we've just pushed future profits into today, right? When a stock price rises beyond its average valuation, right, this historical trend line of fairly valued, all you're doing is pulling future returns into today, which means that if you're the one buying it today, your future returns are less. So that's good for the seller and bad for the buyer, right? And you don't want to be that person. You want to be on the opposite end of that. You want to buy when things are down here, right? And there's blood in the streets, and you're buying assets that are undervalued, not overvalued. That is the key to long-term investing. Now, some people will just say, buy for the long term, it always goes back up. See, you could have bought here at the peak, and it's back higher. You could have bought here at the peak, and it's back higher. But you might wait 15 years before it gets higher. Right? If you bought the NASDAQ, and you just bought that index, and you bought that in 2000, it took until 2015 for that to get back to its previous all-time high. Right? But this is basically, more than 2 standard deviations. We've never seen it this high. That doesn't mean that it can't go higher. It probably will, matter of fact. It probably will. Because everyone's going to believe what the Fed tells them. Everyone's going to believe that the economy is recovering. Everyone wants to believe all of these things. No one wants to face the reality that market demographics and debt are working against us. But those are the truths. So hopefully that's been educational for you. Hopefully you learned a little bit today about our bullshit economy and why it's bullshit. And you now have some tools to go back and reassess your investment strategies and where your money's at, and consider that these records can't go on for forever. Eventually things will revert to the mean, and there will be a whole lot of economic destruction coming out of this. So I want everyone to protect themselves. I want you to protect yourself and your families, and know that that's what this is. I believe that the next massive crisis is going to be once these pensions figure out that, oh yeah, they have to invest in these junk bonds, and the junk bonds go bad, and the pensions can't afford to pay. And now all of a sudden you have a ton of retirees who are getting a lot less in benefits. That's not going to grow the U.S. economy. That's going to hurt it. And I do believe that our technical advancements in the long term are going to help us out, but we have to get through this short-term huge amount of debt. And I don't see any way that happens in the short term, because just as Lacey Hunt pointed out, the governments are going to keep printing money, and that's going to make the inflation worse while the economy doesn't grow. So we're going to have stagflation, and that's going to be very painful, especially to that bottom 20% of households whose wealth barely grew and who are relying on public benefits to make it by. And it's going to get harder and harder to rely on your public benefits to make payments when inflation keeps going up at 10% a year. And I believe that that will be about the average for the next decade. So do some things to protect yourself with that, and do some more education to understand what's really going on out there, and don't believe the headline numbers that they give you, and certainly don't believe that the people at the Federal Reserve know what they're doing. This is an experiment in finance that's been going on for 50 years, since the transitory, and always know that there is nothing more permanent than a transitory government program. The transitory nature of the U.S. coming off the gold standard 50 years ago, next month. And we're going to play that video from Richard Nixon and talk about what that's meant for the U.S. and talk about what that's meant for gold and the gold markets, and how gold has performed as an asset, and why central banks are buying gold. Meanwhile, making it harder for banks to own gold, interestingly enough. And why that might be a good piece in your portfolio. And I also want to do some conversations on portfolio construction and ways you want to think about it. And I got a lesson a very long time ago taking a class, and the professor of that class had pulled down some worksheets. I don't even know if he was a professor. I think he might have just been a private individual, because it was not in school. But he gave us some worksheets, and he said, you can see how correlated what you're purchasing is to the overall market. And we believe that all of these things aren't correlated, but it turns out most of them are. And that really changed my perspective a little bit on diversification and market portfolio analysis. And I want to talk about that, and some ways to think about that, and some ways to adjust that. And that's also very much discussed in the Dragon portfolio. And if you haven't read that piece, I highly recommend that one. And I will be using that as reference as we discuss portfolio construction and some of the things that you can do to protect yourself going forward. So thanks for listening. Pass along to friends and family. Look forward to talking to you next time, and have a good one.